Good morning. It's still morning. I'm Karina French. I'm the manager of climate resilience research at EDF. And on this panel, we're going to be talking about an issue that we've already been talking about quite a lot this morning, the challenge of inequitable recoveries after disasters. And as many panelists and speakers have already noted, disasters can create big financial burdens to households, and worse so for those who are already in economically precarious positions and those without insurance. Yet insurance is inaccessible and unaffordable to many. Today we're going to highlight some of the different approaches, perspectives, policy examples, and programs that people have been piloting across the country, and for a more fair and equitable recovery and insurance market. And I'm pleased to introduce our panelists who are going to tell us about that. And they represent a range of sectors and expertise. So starting on my left, we have Zach Rosenberg, co-founder and CEO of SBP. We have Theodora Makris, program manager at the Center for New York City Neighborhoods. We have Jonathan Gonzalez, co-founder and CEO of SBP. Raincoat, I'm so sorry. Raincoat. Yeah. We have Daniel Schwartz, the Frederickson and Byron Professor of Law at University of Minnesota Law School. And finally, Jackie Higgins, Head of Public Sector Solutions for North America at Swiss Re. So before we dive into policy examples, we all wanted to take a few minutes to describe the different facets of the problem that we're solving for. So starting with Theodora, the Center for New York City Neighborhoods works to support working class homeowners, including after financial disruptions. So in broad strokes, can you describe the inequitable disaster recovery the center has seen in communities that you work with?
This is on? Okay. It's nice to be here with you all. I think there are like 2 or 3 main issues that the center sees on a consistent basis. The first being that in this space, flood insurance is just simply unaffordable for many low-income families in New York City. It's just not an expense that they can afford, and particularly with other issues that they have going on, it's just not top of mind for them every single day. Another thing that we have are a disproportionate amount of low-income homeowners who reside in floodplains in New York, and so their experiences are much different than other communities across the city, and so that's another issue that we're contending with. And so that's kind of the big one. I think the other issue that we find is that federal aid or even payouts from insurance companies take months, sometimes years, to arrive at the home. And in the meantime, wealthier families can begin their recovery process, but low-income families simply have to wait much, much longer to rebuild, which imposes all sorts of financial problems that can be felt sort of in the short term and the long term. And then finally, I think when aid does arrive, it's often met with restrictions that really limit where families can spend their money. And so it actually really affects how, or I guess like the myriad of costs that they have to pay for. And so I think we see these issues playing out both in the short term and the long term, but also on the homeowner and community level. And I think with insurance, something that we know, right, is that that is sort of the best way to protect against household finances. And so coming up with affordable solutions is really, really important now with increasing risk that we're seeing across the city.
Daniel, much of your research focuses on insurance regulations' effect on policyholders in the market. What characteristics of current insurance market regulations generally make it more challenging, more expensive, less fair for some households to benefit from insurance?
There we go. Let me start out by picking up on a theme that we heard a bit about towards the end of the last panel, which is uniformity and the lack thereof and how that can affect recovery. As we heard in the last panel, having uniform incentives across time makes it much easier to communicate with consumers, makes it much easier to have a plan, and makes it much easier to sort of build in that information into sort of regulatory structures. But right now, there's a lot of lack of uniformity in insurance coverage. And that lack of uniformity is not only, I think, with respect to things like deductibles, things like specific carve-outs that maybe people somewhat understand, but it's also with respect to a lot of the details of insurance coverage. And that makes it much harder just to tell people, here's what's covered, here's what's not covered. And I think if any of you know, well, an insurance policy doesn't cover flood, but check your details of your policy. Well, who's going to do that, right? So I think one of the initial challenges that exists from a regulatory front is that we have that heterogeneity in terms of insurance coverage terms that makes it very hard for people to get basic answers about exactly what should be covered and what shouldn't. A second real difficulty, particularly for low-income communities, is oftentimes there's more of a presumption of the potential risk of insurance fraud. And that can oftentimes exist both sort of subconsciously in terms of claims adjusters. It can exist because historically there may be certain patterns of insurance fraud in insurance communities that can get then reinforced through AI, which is automatically flagging it. And so this is a really challenging issue, but it's part of why I think, linking to the earlier comments, there's oftentimes a lot of delay. So there's more scrutiny. Well, is there fraud involved here? What are the markers of fraud? How do I flag it? And then that can create some problems as well. Finally, navigating the insurance claims process is just difficult. It takes resources, it takes time, it takes education, it takes confidence. Okay, and as someone who is both an insurance expert and spends a lot of time fighting with my own insurers, and then eventually, usually winning, but not always, I know that it's difficult for a lot of people to navigate that process if they don't have support, if they don't have confidence, if they feel like they're being targeted automatically, if they feel like there's an assumption that there's fraud, if they feel like they need to read their particular policy and have their particular, and so I think those are a lot of the challenges that exist and that are really amplified in low-income communities in ways that regulation sometimes deals with, but oftentimes, too often in my view, does not adequately deal with.
Jonathan, co-founder and CEO of Raincoat. Can you talk a little bit more specifically in that phase of rebuilding? What challenges have you seen policyholders face with traditional disaster insurance products?
Hey everyone, thank you for having me. I think to start, I think Daniel and Theodora mentioned a lot of the issues, but one of the things that I want to highlight, which is always really interesting, is that when you think about disaster insurance, as you mentioned, what do people normally think about within that context? There's a good chance you're thinking about property, right? Very much the conversation is about assets. But the reality is there's a large group of the population that don't own property, don't have those type of assets. I'll give you an example. In Puerto Rico, 40% of the population rents. So is the claim that if a hurricane hits Puerto Rico, that 40% of the population is unaffected by the hurricane in any way whatsoever? So one of the biggest challenges is that insurance definitely does not affect everyone equally. But very often what I find, particularly when we're looking at the bottom of the pyramid, is a complete lack of insurance. Lack of insurance because the current models of definition of insurance oftentimes focus on this asset and this property and don't cover other things like loss of income, excess expenses, the fact that you're in a disaster-prone area and your life has been completely disrupted. So it's more about developing solutions and products that can target at those. For the ones who do have insurance, you have all the issues that have already been mentioned, the delay in time that recovery can take, the fact that oftentimes people may not necessarily understand the policy that they have. I'll give you my personal example of how I got into Raincoat. I moved to Puerto Rico in 2017 to take care of my mother. Hurricane Maria showed up a couple weeks after that. My biggest concern was whether or not she was going to be okay. She was in a wheelchair at the time. And the ramp that she used for her wheelchair had gone off with the hurricane. So I asked her if she had insurance, and she gave me her insurance policy. It was like 40 pages long. I didn't really understand most of it, but I did understand how to file a claim. And I did exactly that same week. We ended up waiting about a year for a claims adjuster to show up. A lot of this because of the demand and the volume, right? It's not necessarily the insurance company's fault, but rather just the amount of volume that shows up after this type of disaster. And at the end of the year, the claim was denied, right? And that was my experience, my first one with insurance. So these are really the realities for a lot of people, but not everyone is affected equally.
Now that we've kind of covered different aspects of this challenge, we're going to dive into some of the solutions that you all have been working on. All of you have been researching, piloting, or implementing models that can increase access and fairness of recovery and insurance through various approaches, public and NGO programs, new private insurance models, legal and regulatory reform. So let's discuss some of those. Starting with you, Daniel. Explain to us some of the legal and regulatory policy changes you see as necessary for a fairer insurance market.
So the first one follows pretty naturally from what I said earlier. I think there needs to be more uniformity in terms of what policies cover. And a lot of the lack of uniformity that exists now is honestly not driven by the need to manage risk. It's driven by the fact that the regulatory environment has allowed different insurers to evolve different policy language. And it just makes it so hard to offer basic advice to people about what is covered and what is not, because that requires the 40 pages of policy language and so forth. A second really important key piece that I believe needs to be in place is better data about claims payments. Right? We actually collect that data now, and we've done a lot of good work in making that data collection better through the Market Conduct Annual Statement. But that public disclosure of that data is not sufficient. It's not sufficient at the zip code level, so we can see differences in claims payment across areas. It's not sufficient at the individual company level. Why can't we know whether one company is taking longer to make payments, is making less payment than another company? Insurers will tell you that this is proprietary data, and it's just BS. It's not proprietary data. It's about what their product does and doesn't do. And if an insurer is not willing to provide information about what its product does and doesn't do, I think that is a problem that regulators need to fix. I do not understand why regulators have been dealing with this for 15, 20 years and still not willing to push insurers to actually do something, except for the fact that insurers have enough power to bend regulators to their will. It's just not, in my view, acceptable. The third thing is I think that there needs to be better regulation about how fraud detection occurs and about the ways in which we presume fraud, because I do think that a lot of times that ends up disproportionately affecting low-income communities. And just because there has historically been more fraud in one area, that doesn't mean that you should start off with a presumption that everyone who files a claim in that community has some element of a fraudulent claim. And so I think that is a very tricky issue, and it's going to be an even trickier issue with AI, because you pair with the fact that, like, yes, historically there are certain areas where maybe there has been more insurance fraud, but then you systematize that so that you have a presumption of fraud everywhere, and that only decreases the trust that people have and their sense that they're going to lose at the end of the day, that it's not worth trying to navigate that process. So I think those are some of the regulatory solutions that are out there. Some of them are very simple. Let's just get data on like what insurers pay where differently. Let's get standardization of policies. I think questions about what we allow insurers to do in terms of fraud detection are trickier. It's the final thing I'll say is I think we need more affirmative support from the state to facilitate claims handling and claims disputes after the fact. There's been a lot of experimentation at times with state-supported forums for quickly resolving disputes, but a lot of times those mechanisms are more available in affluent areas. People know more how to use them. People are aware of the fact that they can go to their regulator and maybe have them intervene on their behalf, but they're not broadly accessible. So to the extent that people do have the insurance in these lower income communities, we should have mechanisms in place for allowing them to challenge that, for ensuring that they get their coverage paid quickly, and for ensuring accountability when there's not. And right now it's way too ad hoc.
Thank you. Moving from policy to programs, Zach, SBP's programs are designed to fill and fund the recovery gap directly, especially through the Recovery Acceleration Fund, which we've heard a little bit about before. Can you tell us more about that program and how it works?
Sure, and it's good to be with everyone today. Huge kudos to Helen for organizing this with Carolyn and the team. I apologize for being a couple minutes late. I'm actually an alum of AU Law School. I haven't been in this building since, and I ran into one of my old deans who kept talking. So I apologize. I'm going to zoom out for a minute first and talk about why SPP exists and what we're solving for. After years of building thousands of homes, rushing in on a white horse, helping people, we realized that the work that we were doing could never be scalable. It was reactive. And in a certain way, even though we built thousands of houses, kind of offensive, because for people to get to us, it was predicated on them suffering in the first place. And if you really care about people, the solution can't be wait till people suffer and then help a very limited amount of them. So we evolved our thinking, and SBP's thinking became, what are we really doing? And this was under Francis's remit as board chair. He created the space to come up with truly client-centered work. And we came to determine that our work is fortifying people against their breaking point. That time after disaster, when they're never going to be the same again. For some, they're alive but not living. Others pass away. For seniors in the golden years, they're forever tarnished. And for some of us who are parents, what hits the most, me especially now, is during these time-limited formative years, parents can't be present. And raising kids is tougher. And so we realized there were three things that lead to the breaking point: the amount of time between disaster and recovery, the amount of predictability people have. More predictability, it's going to actualize and bring forth our resilience. Less predictability, it's going to repress the resilience. Then access to resources. So what Karina asked about is a scaled solution that presses on each and every one of those three levers. We've seen, and I'm going to zoom out for 1 second, but I'm looking to Helen for nonverbal cues. And they can be very overt, Helen, if they have to be. I want to center us where we are in this industry. I'm not going to pick on insurance, but I'm going to pick on housing. If there's three sectors in America's history that are most rife with bigotry and intentional in the past, hopefully, but now maybe still in reality, racist policies, it's education, it's healthcare, it's housing. And so as we're talking about insurance, we're talking about as it applies to a sector that we can't see as divorced from this very clear policy enforced history in our country that has closeted certain populations into both less desirable, more at-risk neighborhoods, and has also structurally taken away resources and infrastructure from those communities. I will send a link to the group about a Washington City paper article that lays this out extraordinarily well in a city that's near and dear to many of us. So I just want to make sure we understand what we're talking about. The Recovery Acceleration Fund is, and it's working great, designed to help people who will eventually qualify for the federal HUD money recover in a prompt, efficient, and predictable way. For years, the most efficient way that cities and states who have used HUD money have helped people is to let them spend their own money and then reimburse them afterwards. Spend your money, reimburse them afterwards. Kind of makes sense. Doesn't work for the majority of the population. You guys, everyone's seen the studies that show what percentage of people have $500, let alone $2,000. It's de minimis. And so what the Recovery Acceleration Fund does is it raises investor and philanthropic capital and creates an opportunity for moderate, low income, or just regular American people to access that very same pathway that's worked so well for people with means. We lend the money to them, we rebuild the houses, and then we support them in applying for reimbursement from the government, and it pays back the fund. To investors out there, this pays a 6% return. Pretty darn close to a government-backed security. For those who care about what others are doing, Kresge's in. It's pretty good, right? And so we piloted it in Louisiana, and we're scaling it. And if I can just make one more point, we're scaling it in Florida. And there's a lot that's going on in Florida that should give many of us concern. Anti-history, all sorts of other challenges. Yet what we were able to do is work with the government there to drive a client-centered solution that arguably is going to help people that the government's attacking many days. And so as we're thinking about system change, we've got to think about how do we reach across the aisle and create system change that's hearable and delivered in a packaged way that can be embraced and is actually practical. I rest my case.
Thank you. Theodora, the center has been working to solve similar recovery challenges, but through a different model. Tell us about the flood recovery fund the center has been working on and the New York City Inclusive Insurance Pilot.
So on top of some of the things that I mentioned earlier, another thing, as we know, New York City is having to contend with is rainfall floodings, increasing in both frequency and severity. I think with very good reason, after Hurricane Sandy, there was a lot of attention paid to building up the resiliency of New York City's coasts. And I think 2 years ago after Hurricane Ida, it really pointed out a lot of the vulnerabilities that New York City's inland communities face with respect to flooding. As I mentioned earlier, right, disproportionately affects low to moderate income homeowners. And so really big problems that we're trying to work out. And I'll just go on the record in saying I'm like by no means an insurance expert. So everything that I'm saying here, I hope I'm kind of reflecting the work to the best of my ability. But essentially, the Flood Recovery Fund is an emergency grants program that provides unrestricted, immediate funds to qualified homeowners in the aftermath of a flood event. And that program is supported by a parametric flood policy that we've worked on very closely with Guy Carpenter and Swiss Re and Helen and Carolyn and my colleagues Carlos and Tally. And so we've been working on this for a very long time, and I'm very excited to announce that we're within the coverage period. And so the fund itself, sort of how it looks in practice, is when the center, as the insured, receives confirmation that a qualified event has occurred, an application will become immediately available to homeowners to apply to. Pretty straightforward, you know, through an iterative process, we've decided to really expand the eligibility criteria and lower the burden of sort of proof and paperwork in order to kind of expedite the process for people. And so those funds, when they arrive, can be used to pay for any of those emergency costs that we know are sort of unpredictable, whether that be a disruption in your income because you can't get to work because the subways are flooded, or you need to pay for a generator or some emergency childcare. And we're really excited about that because, you know, these costs are really unpredictable. And so it's good to know that those homeowners who need it will have that access. I think another important thing to remember as well is the intervention that we're trying to solve for isn't necessarily to make a family whole. We understand that the funds you use in this program are not going to like totally fix everybody's problem, but the really problem we're solving for is that sort of timing gap where low-income homeowners really have to wait much, much longer to start their recovery, and that we hope by providing these grants up front, it sort of minimizes the sort of downward spiral that we see happening after a flood event and really stabilizing household finances. So that's really the problem we're trying to solve for with this program, and we're very excited. I should say too, right, like the ability to have like an unrestricted sort of funds program is because of the fact that there are no like grant requirements at the moment. This was a fund that we received through the National Science Foundation, and as a nonprofit, we are very aware of the fact that, you know, the funding that we get is often, we have to be very careful about how we spend it. And so, you know, in its pilot year, we're really excited about the opportunity to deliver sort of rapid and unrestricted funds to folks.
Great, thank you. Jonathan, Raincoat was started to address a similar problem of low-income households not having the resources needed to recover, but with a different insurance structure. Can you tell us about Raincoat's microinsurance model?
So I guess I'll start off with some context of where the problem stems from and essentially how we've adapted to it. So as Francis mentioned earlier, microinsurance and an embedded approach is a solution, but why is that necessarily a solution? So for at least the last 2 decades, there have been these insurance structures called parametric products. Theodora mentioned it, which allow for the rapid deployment of liquidity, right, of cash after some sort of an event based on parameters that are measured. It's a very interesting concept, very powerful. Lots of countries and regions use this as a way to have liquidity. But when we were looking at that space, we realized that most of the innovation that was happening there was happening at a very macro level. And oftentimes in some of these programs, maybe the resources weren't getting down to the individual level, and you weren't really seeing a lot of solutions protecting individuals, right? Like people, normal households, small businesses. So we started to ask ourselves why that was the case. And what we found was that outside of the challenges that are inherent in insurance, there were a lot of software-specific issues whenever you would deploy at an individual level. Things like if you have a product, right, and you want to protect a large population and there's a big hurricane, how do you notify everyone that the event has happened and that you're going to execute a payment? How do you transact a payment and track it in a direct way? So there were all these software challenges. And in that process, as we developed a lot of that, so we're a software company first and foremost, we realized that oftentimes the hardest thing is getting to people. Like, how do you actually address the gap? Because by definition, the gap is not insured, which means that reaching them through very traditional methods, whether that's agents, brokers, or just digital channels, is quite difficult because they don't know that these types of insurance products exist, or they don't know that they can get coverage for these things, or they're completely excluded, right, from the normal like insurance industry. So the question was, how do you get that benefit down to individuals? And the way that you do it is by embedding it within the channels that those people interact with, whether that is products that they already have, could be financial products right through a bank, or even products that they interact with from a consumer perspective. So for example, in Puerto Rico, we had a bunch of really interesting deployments where insurance coverage is being distributed attached to some sort of other commercial product that normal people interact with. So you buy a Hyundai car in Puerto Rico right now, and it comes with a hurricane cover attached to the sale of the car, not to cover the car, but to cover the person. If you buy specific coating for your ceiling, it comes with a cover that now gives you money after a disaster because you bought from that particular brand. And we have found ways and schemes to be able to set up climate protection in ways that is actually sustainable from a marketing perspective, and because the premiums are being covered, and you can actually reach the people that need it the most. And these are the cases where you have to use the private sector. In an ideal case, you would do it with the public sector, right? You would do it with a government entity, and that would be the best way to reach them. But we've seen that balance, and what they all have in common is that you're trying to embed a cover within some macro program of some kind.
Very cool. Okay, finally, Jackie, Swiss Re has been thinking about impacts that are currently less covered in the current markets. Can you talk to us about Swiss Re's work on extreme heat and insurance?
Sure. I just want to apologize too with my voice. I just spent 3 days with state risk officers at a conference, and one of the things that we were in Little Rock, and we went to the Clinton Library. And I know this sounds fortuitous, but if there's a whole section on it takes a village, right, in order to put some of these solutions together. And it reminded me when Theodora was talking about the big group that we put together for the flood parametric for New York City, right? The insurers is just one component of that solution. So the panelists have talked a lot about some of the challenges, right? And the parametric insurance solution is just one solution. It's not a panacea. It's not going to solve everything. But some of the things that it tries to solve for is the challenges with the claims process, because there is no claims process. You have an index or a trigger that is hit, whether it is the level of flooding, the shake intensity of an earthquake, the wind speed of a storm event, or in the case of extreme heat, weather temperature and or humidity, for example. So if that trigger is met, a payout, a predefined payout, is received. So one, solving for the claims process potentially, and two, solving for the speed to delivery. On average, these payouts occur within anywhere between, we've seen them in 2 days. We've even seen some entities do it in 24 hours, all the way at most to maybe 3 weeks, which is significant in a situation where a lot of these entities, let's say you're talking about cities, might be reliant on state budgets and/or FEMA disaster assistance, public assistance, or individuals looking at FEMA individual assistance. So the recovery period is shortened. And I would say the third really important component is, what does a parametric offering do? It provides flexibility of funds. So if you think about it as more like a net, it complements other types of insurance. So where other things are not covered by that, either that insurance policy. So if you are a property owner and there are certain things that are not covered, you might take a parametric insurance to cover those opportunities. But for cities, for example, when we talked about it, in the case of a natural disaster, you have other economic losses that are not insured for, because most insurance is based off of property damage. So economic losses, like if we take extreme heat, for example, things having to do with transportation to cooling centers. We know that a lot of cities have put a tremendous amount of money in cooling centers. We can take Los Angeles as an example. No one's going to those cooling centers. Why are they not going to those cooling centers? So the question could be related to transportation for those cooling centers, or maybe if it's even in the case of an extreme homeless population, which we know a lot of our cities are suffering through, they might not even know that that exists. So there's such things as community brigades that can go out, who understand this population, and encourage them to go to a community center. That takes additional time, it takes additional money. We know that a lot of the cooling centers rely on libraries. A lot of these state budgets do not have additional hours put in for those librarians who are keeping those libraries open. That also is an unanticipated cost. We also have things with extreme heat events with respect to the increase in cost of electricity during extreme heat event, or subsidies needed to keep their air conditions on. But there's a lot of economic loss that's not attributed to that, and that's what the parametric products are hope to cover. And I think next we're going to talk about kind of some of those barriers and why it takes a village to create those products. But in general, one of the things we are looking at are entities like in Los Angeles, working closely with our colleagues in the Department of Insurance in the city of Los Angeles, looking at how we can provide a parametric solution in order to cover some extreme heat events. You could talk about the city of Phoenix as well, that we've all been reading about, and the devastating effects of extreme heat there. But you can use it for lots of applications, but we're focused on extreme heat and flood and quake and others right now.
Thank you. Okay, as Jackie has queued up, we are going to now explore a few questions about implementation of these ideas, covering some common experiences that folks have had. And then we're going to open it up for audience questions for the remainder of the time. So just start thinking about your questions now. So first off, this is a question both for Daniel and Theodora. How have households' historical trust or distrust in insurance impact how you design or think about new insurance regulations and policies, or programs in the case of the Center for New York City Neighborhoods, especially for underserved communities?
Sure. So I should also mention too, right, like the center really relies on a robust cohort of housing counselors and legal service providers who provide all sorts of, home ownership resources to folks in New York City, things like foreclosure prevention services, or they'll make referrals to contractors if people need to rebuild parts of their home. And so the center really relies on those partnerships for like various programs and policy initiatives. But so I'll say, sort of anecdotally and speaking with our partners, I think like distrust, sure. I think it's also, like a resentment too of the fact that I think a lot of people feel, particularly low-income folks, people who English isn't their first language or they're an immigrant, just feel like these systems were not designed for them and it's hard for them to take advantage of them. I think they seem to be highly inaccessible. And by that I mean, most of the time when we hear from people, the sort of claims process just feels and is daunting. It is time-consuming. These are people who work multiple jobs or don't necessarily have like a trusted person who can sort of case manage on their behalf. And to even get through a claims process is quite difficult, particularly if you're like a senior or aren't quite like computer savvy, it just doesn't feel like this is something that people can take advantage of if they even have the time to do that, or feel like I'm going to be denied. What's the point of waiting? I'm just going to, work with what I have and rely on my community to work through this. So of course that's a problem, and I think it just builds up a lot of resentment. I think another thing people find very troubling is the fact that they have their policies, like we said before, maybe don't necessarily read them, it's confusing, but then come to find out that things like property in their basement isn't covered, even with the existing policies that they have. And so how do you contend with the fact that maybe you pay into a policy, but it's not kind of paying out in the ways that you want it to? And people don't have other resources or savings or access to credit to kind of make up for that loss. So yeah, distrust, resentment, I think. I should mention too, right, like community conversations are so important. The reason that we were able to design the flood recovery fund in the way that we did is by this like very important like fact finding and community-based involvement that we have in order to kind of find what the pain points are, and where we can kind of, increase points of entry for folks. So those just kind of generally, I think, are some of the issues that we're seeing people experience.
Yeah, so I think there's absolutely a lack of trust, and frankly, the population at large has a lack of trust of the insurance industry in many settings. But I think that's amplified in lower income communities, partially because of the just unnecessary complexity of some of the process, right? I mean, I think we all understand that there's some complexity, but the level of complexity and the variation oftentimes feels unnecessary. And then a lot of times it feels like a contentious process. It feels like a process where the insurer is acting against you, or the insurer is going to charge you of wrongdoing. And so I think that to get to solutions to that, we need ways of simplifying, and we need ways of having processes that are broadly accessible. So like one very simple idea might be, well, how can we incentivize, for instance, folks to have an inventory of their property, right? It's a very easy, simple thing for folks to do these days. Almost everyone, even in low-income communities, has a smartphone, right? Can take pictures, can upload them to the cloud. And right now, it's not at all the case that people do that uniformly, even though really it's basically costless. So there are simple ways we can do that, and then that can actually facilitate trust, because now we have much more of an evidentiary basis to actually facilitate the claims process. And so why are insurers, for instance, not encouraging that more than they do? They may send out, an email that gets lost in the barrage, but for instance, why not offer a $5 discount, right? If you actually have an inventory and you do it. I mean, people will respond to that. And maybe it's not on insurers to that. Maybe regulators could do that, right? Maybe regulators can, well, here's a uniform idea we have. So I think simple ideas to make the process easier to navigate, to actually incentivize insurers to make the process easier to navigate by having uniformity in the evidentiary base for what the property is there, uniformity in what's covered, uniformity in mechanisms for challenge, is the only way that we're going to actually get past the systemic distrust that exists. Because there's absolutely, there's been a lot of reporting about how low-income communities, they feel like whenever they make a claim that they're fraud accusations that automatically arise. And then that can even lead to folks not even making claims or not challenging claims. So I think we need to start off with simple solutions designed to build trust.
Okay, next question. Pilots and testing new programs often can show us the structural barriers to implementing more broadly, kind of stress testing our system with new ideas. So let's touch briefly on a few of the key challenges in setting up new programs to fill the recovery gap, namely some phrases that I think we've all heard a lot about: duplication of benefits and proof of loss requirements. So in case you haven't heard a lot about these, we're gonna cover those and talk about what a few folks have been doing to try and get through those barriers. Jackie, can you describe the challenge of proof of loss requirements? And then Zach, can you inform us on the issue of duplication of benefits?
So I would also add in another one, insurable interest. And what I mean by that is we all know that insurance is heavily regulated state by state, and there are two fundamental things that you need for something to be categorized as an insurance product. one, you have to have a proof of loss, and two, you have to have that entity that purchases an insurance product to have insurable interest. So it's really easy to say insurable interest with respect to I own a piece of property, therefore I am responsible, that is my financial responsibility, that is my insurable interest. When you have a traditional indemnity insurance product, not parametric, but just you purchase an insurance product in your home, the proof of loss will be the claim adjuster coming out and saying, yes, I see damage, there's proof of loss. When you have a parametric, it's a little less obvious as to what the proof of loss is. So with respect to parametric, we do still have a proof of loss component, but it is really an affidavit that they say that, yes, I've suffered some sort of economic loss. It's a little bit easier. On the insurable interest piece, one of the things, and I said it takes a village, is each regulator in every state has a different, there's some fundamental things about insurance, but they all have a different perspective on what can be quote unquote insurable interest. So for example, if we're trying to think about having cities, counties, not-for-profits purchase insurance product to benefit individuals, right? They need to define that that is their insurable interest. So for example, if I'm a city, I am responsible for the citizens and the health and welfare of those citizens, all citizens in that city, but I don't own them. They're not owned by me. So the question is how do we define that that is therefore their insurable interest? So let's, for example, working with the Department of Insurance in California. Now again, we're all talking about California. We have two individuals here, Mike Peterson and Deborah Halverstadt, who represent California. They are arguably the most progressive, being that they're the seventh largest insurance, and we're looking to them, quite frankly, to kind of set some systemic changes that could potentially carry out for the rest of the U.S. But so they're not typical of what an insurance regulator and how they would view this product. But so, for example, if you look at an extreme heat event, if a city, let's say, has an extreme heat action plan and says, in the event of an extreme heat event, I am responsible for doing XYZ for my citizens, therefore I am saying that I am responsible for their health and welfare, then that could potentially, still working through, be counted as their insurable interest, something that they can point to. So it's complex. And if we're trying to create these parametric products to support other economic losses not related to property, this is one of those challenges. And it's going to be, quite frankly, on a state-by-state basis as to whether or not these kinds of products will be considered insurance. The other way to do these kind of products is more on a security side, and you can structure them as derivatives, super complicated on another part, and then you get into a whole host of other issues on capital markets as whether or not you're a qualified buyer of a security. So to say the least, it's super complicated, but I think that the reason why we're doing these pilot programs with areas that are most permissive is just that, to create demonstration effects, demonstration products that hopefully will then carry over to other states and regulators in other countries so that they can see the benefit of these products.
Take on duplication of benefits.
Oh, I want to take on duplication of benefits, all right. So I'm going to talk about two themes. Remember, we talked about what leads to people being pushed beyond their breaking point. Time, predictability, and access to resources. That's one lens we should have in resilience and recovery. The other lens, I think, from business we can think of is you achieve what you measure. And so in the federal recovery space, certainly with FEMA, but also with HUD funds, they measure compliance and preventing fraud. Arguably, they achieve it. There is no outcome-based recovery work in America today. When the contractors come in and go to the towns and cities and states that are going to get billions of federal dollars, they scare the heck out of them, and they talk about preventing fraud, preventing clawback, and compliance. What we do at SBP is we disintermediate and we disrupt. We hired Nikki Haley's head of recovery, a former Army colonel, and he has a whole crew of government advisors that work with city and state and local governments to be honest actors and truth tellers. So when the federal money is coming, how can they build a system that's focused on outcomes rather than compliance? Compliance matters, but compliance is only useful to the extent it's tied to outcomes. Duplication of benefits is an archaic, probably race-based component of the Stafford Act that, again, is archaic. Stafford Act, I don't know, you're nodding, so you probably know when it was passed. When it was passed? Wow, it's older than me. And, well, Loving versus Virginia was, thank you. I really like you. It was 1979. So that was an era where paranoia and concern of giving to others who might not look like us was rife in America. So the duplication of benefits, that component that runs through HUD funds and runs through FEMA funds, has created a cottage industry of caseworkers and compliance specialists and others who spend a lot of time and earn a fair amount of money making sure that poor people don't get more than they deserve. It is a pristine example of focusing on compliance rather than outcomes. So when you, Karina, I don't know if you knew what you were asking me, like, do you want to take on duplication of benefits? I sure as heck do, and I hope that we all do. And one thing, I'm going to host a panel tomorrow where you guys may upgrade and get Francis if my flights are canceled. But I want us all to think about it. What are the sacred cows? You know, Francis talked earlier about insurance as a catalyst. The Harvard professor, I'm sorry, I forgot your name. You have an identity besides being a Harvard professor. Susan talked about if Congress can actually have a bipartisan solution. Well, that's where we have to be spending our time, right? What are the sacred cows? What are the but-fors that are preventing the change that we all in the room know needs to happen? So we can have these brilliant solutions, but unless we're dealing at the top of the house on the Hill, unless we're finding some way to get people to pay attention, unless we're getting the CEOs of the insurance companies to say, this isn't working. This is an existential threat to our industry, and frankly, it's an existential threat to our society, and we're gonna do something different, otherwise we're consigned to accept something none of us want. These are great conferences, but it's not gonna work. So I challenge and ask for your partnership. How are we gonna get to the top of the house? Who's gonna get that CEO? Who's gonna call the other CEOs and say, we can't be on the margin with 5%. How are we all in? How are we gonna get your congressional bipartisanship that we laughed, everyone groaned? That sucks. So how are we gonna get it? That's probably not the answer you want, but if you ask me, do I wanna take on the Stafford Act? Yes, and that's the way to do it.
Thank you. Okay, final question, and then we'll open it up to the audience. So get your questions ready. This is for Jonathan, but also the rest of the panel, please do jump in if you have thoughts on this. So designing new insurance models that serve a specific population or a specific recovery gap clearly requires working with communities more than traditional insurance products or maybe companies have in the past. Can you tell us more about the specific community or institutional relationships that you have found most important in designing your policies at Raincoat and the scale of engagement that you think is necessary moving forward?
I have to definitely echo what Jackie said. It definitely takes a village. 100% takes a village. And I would say there are 4 big buckets or categories that are kind of required for this to work at scale. The first is the community, definitely the population that you actually want to protect, in part because it gives you the context of that you need regarding what is actually being covered, what is the actual risk, and what are their actual needs, right? So the first one for sure is the community. The second really important component is then the regulator, because that is what limits you regarding what you can actually provide for that community. I've had so many debates throughout the years related to proof of loss, related to duplications. Like, this is actually a pretty difficult thing to resolve sometimes. And the cool thing, or the good news, I would say, is that oftentimes these products make sense for regulators. The problem is, how do you navigate the laws that are already in place, right? So you can usually work with them to figure out alternatives or ways to go around it, or even sometimes create entirely new laws, like in the case of Puerto Rico with the microinsurance law. But that engagement is absolutely necessary because there are certain ingrained like beliefs and structures already in place, and you have to navigate those. The third big component is, how do you actually reach the people? Whether you're reaching them when it comes to providing the cover, or even how do you reach them when you have the payment that you want to give them? This is oftentimes a bit of an afterthought, but it's very critical. I mean, not just on distribution in the sense of the benefit, but also the payout part of that equation. So you always need some sort of system in place to be able to distribute, some sort of partnership in place, whether that's private sector or public sector, to actually get the message out, to actually get the product out. And that can take very different forms depending of the population that you're trying to protect. And then the last component is really the risk taker, the insurance industry, right? The players that ultimately are the ones who are going to retain that risk, who need to model that risk, who need to understand it, and whom are on the hook if these events happen. And I think when you can line up those four components into a conversation, you can sometimes create really unique and just impressive things that solve at the target, because all of the context that's necessary is being included as part of that solution.
Any other thoughts from the panelists about kind of institutional relationships that are really critical?
I can share, just to sort of piggyback on what I mentioned earlier with respect to our network partners. I mean, to kind of go a bit deeper, they, in having conversations with them about what are some of the pain points and how are ways that we can kind of work around them, and even just like anecdotally, things that I've heard, things that I've experienced. Broadening eligibility criteria, for instance. So the center runs like several programs of our own in partnership with the City of New York, and we have, state partners as well. And so we're sort of aligning the eligibility criteria for the Flood Recovery Fund with some of our other existing programs, but that's sort of been refined over time. And so really kind of leaning into those parameters as a start. Another thing that we learned over time and was sort of reaffirmed by our partners is like, lower the documentation requirements. I can't find the deed to my home because it's now underwater, and I don't have my tax returns because I make my income in various ways, or whatever the case may be. And so how can we kind of hear that and respond to it and try to make an application that feels that it's something that they can engage with, and that they don't see and decide, what, this is not worth my time, or whatever it is. So we really took that to heart and designed something that I think is easy, at least easier than other kind of similar programs that I've seen that do this sort of work, about duplication of benefits. While I absolutely agree with everything that's been said, I think the fact of the matter is, like, we need to kind of include language about that, so that funds received from this program doesn't preclude applicants from receiving funding elsewhere. And so we included duplication of benefits information, like right at the top of the intake form, all the way through to a grant agreement that somebody might receive when they've been told that they qualify for funding. And so those are sort of the things that we hear and that we've tried to model the program off of. And I thought there was one more, but I'll just leave it at that for now.
Awesome. Well, no more thoughts here on the panel, so we'll open it up to questions. And I'll just go with hands that I see first. So go ahead.
I don't know, that's really interesting. I would look at Mike Peterson, who's sitting there, for him to think, given that you're at St. Louis Obispo. And I mean, that's an interesting perspective. I mean, they are reliant the cities themselves are reliant on tax revenue. So the event that you have a natural catastrophe and it affects revenue, then the question would be, that's an economic loss for sure, but do they have an insurable interest to ensure, do they have an interest to ensure that revenue is created? I mean, that, I would leave that to the legal scholars, but it's something to consider.
So one thing about this insurable interest requirement that puzzles me is, the whole idea of insurable interest is we don't want people using insurance to gamble. And it was really not meant to deal with counties
Exactly.
getting coverage. And as I understand it, this is more of like a theoretical concern, right? Like it's a concern that someone may raise an insurable interest objection to recovery. So like it seems like there should be like a really simple solution of like states just passing simple statutes that say there's no insurable interest requirement with respect to the purchase of parametric coverage by counties or other government entities. Would that not be a really simple way of just solving this entire problem?
Yeah, I mean, it's akin to the fact that oftentimes state regulators do not even regulate the purchase of insurance by cities or counties. They're really just looking at individuals and or corporates, right, purchasing insurance. So that's what I meant by it's state by state. And that's what's so challenging about creating solutions, is you have to really work with a group and a community state by state. And that's why you're not seeing large scale rollout a lot of these solutions, because it takes so long from a pilot to pilot. But I would agree, there should be a super simple fix, especially when it comes to public entities and or not-for-profits wanting to purchase these kinds of products, rather than if it's a commercial and or an individual who is trying to make profit off it. So I would think that you should look at a profit as are you making profit or not off of the purchase of this insurance and or derivative? But I, again, leave it to my colleagues in the regulator community.
Okay, we're going to take some more questions. One over here.
My name is Kate Stillwell, founder of Jumpstart Insurance. But I'll be moderating this afternoon. I wanted to share my experience with you because as moderator, I also want to briefly issue of proof of loss and insurable. While it is a challenge, it is not a blocker for being able to get community out in practice. Venting. What we learned in rolling out a parametric insurance product for consumers after disaster to be able to process for it. But we thought that the would benefit from the affordability. Both of those comments, those features. What we learned in talking to our first is that far and away above the affordability is the lack of arbitration, the fact that the individual restricted funding, far and away above the highest value level the playing field, brought back into balance the power imbalance between the
Sure. Okay, next hand, and then we'll go over there. Go ahead, Carlos.
On that note, I'd like to ask all of you, your program, how are you?
I'm happy to share. And one note, when you're the moderator, you can do whatever you want. It's a beautiful like exhibit of non-entitlement that do away with it. So with the recovery, I'll talk about two programs really quick. With the Recovery Acceleration Fund, we are in 2023 and 2024, we're going to rebuild 100 homes for 150 families, pay our investors a 6% return, and oh man, Anya knows better than I do, but I believe create $37 million of reserve. Nope. It's a big multiple of what we would spend of preserved equity for families who own these homes. And that's a big deal. So if we're thinking about affordable housing, most affordable housing in America is keeping lower income people in the homes that they own and preventing that hard-won equity to being lost to investors. And so this year we're on target across the organization to preserve $37 million over 600 homes of equities for families that would otherwise be lost to investors. It's a big deal. At the same time, each of these homes is going to have a fortified roof and be built to the fortified standard, which is an enduring benefit for the families who live there. Finally, I'll talk about one other program in freeing up capital. We launched, I'll be humble, the best value in philanthropy today by launching Recovery Acceleration Fellows Program, where we've descended fellows into so far 3 communities, and their remit is to, and you guys remember how the brick money, where'd it go? Great idea, but it went to the coasts and it went to the big cities, and it went to those who could write for it. So understanding Cedars was coming, understanding Justice 40 was coming, and understanding, frankly, it's the right thing to do. We descended these fellows into these communities, and they had financial remit outcome. We thought it would be a win. We pay them $65,000 a year each. We thought, oh, wouldn't it be great if they bring in $5 million worth of federal funding for their communities. This year, they're on track to bring in $80 million across 3 communities of resilience and community development funds. Sometimes, like the bridge, can be really affordable. So those are some outcomes that we look for.
So, you know, the flood recovery fund, we're under the coverage period now, but we haven't had a qualified event yet. If we were to have a qualified event, I'm working very closely with Karina to develop some sort of post-pilot evaluation surveys that would be dispersed to homeowners who have received funding to learn if the funding was useful, how it was used, and try to drive at some of learning about, you know, how their recovery went, essentially. In the absence of that, I think another thing that we're really kind of working on as an organization is funding for year 2 so we can keep this pilot going. I'm looking at the people in the room who have money to spend. No, I'm just kidding. But really, like, the only way to kind of know whether or not something like this is useful and scalable is to be able to test it over time. And right now we have funding for the first year. A lot of the things that have also been talked about on this panel are sort of kind of above like my head, but something else that I think is a really big consideration for people who, or organizations that want to take this work on is, you know, meeting with regulators and learning whether or not like your organization has an insurable interest to be able to purchase a product like this. We worked very tirelessly to try to arrive at that answer. And so I think for future sort of iterations and how we can evaluate, I would say like those are the sort of things that a nonprofit, an NGO would really have to contend with, is like whether or not you have insurable interest. Do you have enough kind of financing in your reserves to be able to like show that you're credit worthy enough to even take on a policy like this? And so these are really like the considerations that I think other NGOs would need to think about if they want to sort of replicate this and adapt it to your jurisdictions and municipalities and the interventions that you're trying to address. But those are some of the things that I would say.
Yes, whatever you want.
In our case, since we work with so many deployments and are normally kind of supporting it from a software perspective and making sure that they can come up, for us, it's 2 simple metrics: how many people were you protecting and how many have actually been paid out. And I would say that In many cases, it could be hundreds of thousands to millions of individuals, so we're really looking at large numbers. And then when it comes to activation, it really means is money actually being delivered and how rapidly and how fast? So we measure the time aspect, right? And then the amount. There are some markets that we're in where there's an activation every single day just because of the size of the region. There's a catastrophe happening somewhere at some point. So our KPIs are very simple. It's people receiving money and how many people are protected.
That's me. A lot of the things that Theodora said is what we're looking at with, let's say, the New York City flood parametric. I think in general, what we're looking at when we want to help cities and counties purchase these products is understanding just fundamentally how insurance can be part of the financial resilience package by relying not just on their state budgets and the federal budgets, but also including insurance as part of their risk management. It's a macro hope. It's not very well understood. Again, they really just look at insurance as part of the solution on property, not on other economic losses that are within the government's budget. So bit by bit, as we do more and more of these pilots and counties and cities talk to their brethren about their experiences, similar to the conference that I was at with the state risk managers, they all talk. They all compare notes, they all gripe, they all talk about their successes and their failures. So that's kind of our little part of systemic change, if you will.
You know, I don't run a program, so I guess I'm different in kind than other folks on this panel, but I'll just say that if we're going to hold different programs accountable by looking at their results and asking, well, how do we measure it? We should also be holding individual actors within the private marketplace by having that data publicly available. That's part of public accountability. And so again, having, you know, a geographically coded data available about what types of claims payments are being made, how quickly are they being made, what types of denials are being made on a company by company basis, in a zip code by zip code basis, I think would be extremely important in understanding the need for having supplements to the traditional insurance marketplace and understanding where either there are regulatory problems or where there's a market need. Right now, we don't have that data.
Oh, okay. Take that question.
Yeah, it's a terrific question. So for compliance, it has to be true debt. And the true debt is, the test is an instrument at market rate. The way we address it is there's a balloon payment, I don't know, 3 or 4 years down the road or in some distant time, with a forgiveness opportunity if for whatever reason we underwrote them wrong and they didn't act in bad faith. There hasn't to this point been a reluctance. So if, you know, we talk about time, predictability, and access to resources, the federal HUD funds don't hit the ground. FEMA, they're supposed to be fully resolved by 6 months. Sometimes it takes a year, sometimes it takes longer. It's a horrendous process. I know our friends at FEMA are trying to do better. It's a horrendous process. 2% of the people appeal. Our appeals team has a 58% success rate, and they generally double people's money, or on average, they double people's money. That shows more people should appeal. Hope is a scary thing. The HUD money generally hits the ground or starts to hit the ground for individuals in month 24 at best. And that doesn't mean it gets everyone at once. It's a trickle, and that can then last for many years down the road. So I realized when I was explaining things earlier about the RAF, we measure success, to our Brookings friends question, by months ahead of 24 months, right? The earliest possible time. We're helping people earlier than the earliest they possibly could have been helped otherwise. So for that reason, we haven't really seen a reluctance to participate. One thing about our model, and there's questions about trust and uptake and program design, the thesis at SBP, we started off as a doing group. Building houses for people is the right thing. We realized that our doing work, our client-facing work, whether it's rebuilding housing, creating affordable housing, or FEMA appeals, that doing work lets us know what it's like from a client perspective. And so those lessons learned about the faults in the system inform, drive, and really require these scaled impact and system change models. And so whether entities are doing it vertically like we are, or associating with on-the-ground doing groups, it's really essential to listen, what's gonna work for the people who are actually benefiting? What do they want? I don't know if that answers your question, but if you'd like to talk after, I'm happy to.
Okay, we have time for just one more question. I see one hand up there, and then just want to encourage everyone to go find the presenters. If you didn't get a question answered, they'll be around. Go ahead.
Well, you guys are getting it right. A couple things. First of all, after disaster, one thing we've seen is that people are essentialized by the way they pay for their housing. So it doesn't matter if they're a mother, a grandmother, a nurse, a teacher, a fire person, anything like that. All it comes down to is, do you pay for your housing do you have an equity stake in your housing, or are you renting your housing? And you go on one of two routes. And I think someone said it earlier, there's a massive challenge for people who are essentialized as renters. Like, it's all stripped away. They're called renters. And home owner is I think it's called appellation. Is that like what a title is? It's a positive title. And renters, it's seen through a lens of suspicion, and at times, well, more than at times, hostility. What Enterprise is doing is our version of a recovery acceleration fund, right? I mean, Marion and I talked about this forever ago, where what can be done to support owners, well-intended owners of low-income housing, so they don't have to wait the years and navigate through that lack of predictability. And in essence, borrow against the future federal funds. I think you're the only ones who are doing it. We're doing it on an owner-occupied basis. You're doing it on a multifamily basis. And I think it's tremendous, and folks should really ask this gentleman about that program. You're the only ones, as far as I can tell, who are doing it right.
Well, we're a minute over time, but I want to give everyone final thoughts. If you want to speak to anything about renters' roles in the policies and programs you are talking about here, and then we'll close up. And I just want to make an announcement that after we finish up here, we will break for 1 hour and for lunch, and we'll resume at 1:15.
I guess I would love to talk to you in more detail after this panel for sure. But I would say there's a lot of opportunity to develop new products and categories like that. And that's exactly what I meant by oftentimes when we talk about climate insurance or catastrophe insurance, it's very specifically within the view of property, and then there's everything else past that. And one of the things that's the weirdest to me is think about the recent pandemic. The pandemic didn't have any physical impact, right? But it had immense amounts of financial disruption, right, across the economy. If a big hurricane or a giant wildfire or a giant earthquake hits a region, it's going to have the financial impact and it's going to have the direct property one. So it's going to be much worse, right, than the case of the pandemic. And it's interesting to me how, in the case of the pandemic, it was very normal to talk about, oh, how do we support people economically in this time of disruption? But when we talk about disasters, it's always about how do we rebuild property, but never about the financial component that is definitely there. So I think there's a lot of room and opportunity for that.
I think I would just say one other thing in terms of a level of hope. One thing that we talked about is, and Francis talked about it, is outside of the insurance industry, right? Who else is focusing on the importance of building codes and natural catastrophe and climate risk? And Fannie Mae actually just recently sponsored, of which I was a part, and other members of the industry in the room, a report from the National Institute of Building Sciences on adaptation measures and the importance of mitigation. So I think that that's a start. So it's not all doom and gloom, right? You have entities like Fannie Mae, which is one of the largest holders of homeowners insurance and has influence over so many lenders, right, across the US, starting to talk about the importance to integrate climate risk and building codes and things like that into that segment of our financial products. So that's just a level of encouragement that I see.
Awesome. Thank you all for staying a few minutes extra into our lunch hour. We're going to break here. Thank you to our panelists, and we'll see you all in an hour.